Good day, grade 12s. We want to move on to recording depreciation. Our objectives are recording depreciation in the books of accounts, recording the sale of an asset, what we call asset disposal, and the fixed asset note. So at the end of this lesson, we must have confidence to record in the fixed asset note. That is where my main focus is. Now, just to browse through acquisition and control fixed assets, we can acquire assets when we buy them by cash. We debit the asset account with credit bank. We also buy an asset on credit. You have to inquire on vehicle finance. We debit asset account with creditors control, or we can trade in, where we can exchange an old for a new vehicle. When we exchange an old for a new vehicle, the price or value of the old vehicle will become now, or will act as our deposit, meaning the business will remain owing the balance. So we debit asset account. If it is vehicle, we debit vehicle, we creditors control. Now, control fixed assets. First one is to keep an asset register, regular repair and maintenance of assets, regular fiscal count of assets, and reconcile with asset register. The use of logbook to check mileage, the use of trackers. Assets should be properly insured against theft and accidents, safeguard assets against abuse by workers. You need to read through, but mostly this is a grade 11 topic. How do we record depreciation? We have to first check on the methods of calculating. We are required to know only 2 methods out of the many methods that are there. You will see as you proceed next year with accounting. We have straight line method, also known as fixed installment method or the cost price method. With this method, a fixed percentage is applied on the cost price of an asset. So we are going to say depreciation is equal to our cost price times the rate divided by 100 times the period divided by 12. So an asset depreciates based on the period it was used in our business. So period is very important as we do depreciation calculations. Our second method is diminishing balance or reducing balance method, also known as the carrying value method. A fixed percentage is applied on the carrying value of an asset. So I'm going to say depreciation is equal to carrying value multiplied by the rate multiplied by the period. And we calculate carrying value by saying cost price minus accumulated depreciation. How do we record? We record depreciation by debiting depreciation account, which is an expense, and crediting accumulated depreciation account, which is a negative asset. If you want to know the effect on the accounting equation, owner's equity will decrease and assets will decrease. Then there are GAAP concepts which are affected with the recording of depreciation. The most common is the historical cost. We have to go through these ones, but historical cost simply says, from yesterday's questions, you are going to notice that an asset is recorded at their original cost price. Then the matching depreciation must be spread over the lifespan of an asset to match the income generated with the expense of that asset. Materiality. We need to review important information. So the amount of depreciation must be revealed or must be disclosed to users of accounting information. through the preparation of the fixed asset note. Then in the business entity rule, we are saying we must separate business transaction and the owner's transaction. That is why under internal controls we need to safeguard our assets from abuse by the workers. So personal transactions must not involve business assets. Going concern, the fact that we are spreading the depreciation amount over the lifespan of an asset, it shows that we are believing that the business will be in existence in the foreseeable future. Then the prudence concept, when we are calculating the value of equipment and vehicles, normally we use carrying value. Then when we are recording the value of land and buildings, we use the cost price method. Even if we know land and buildings appreciate, but we always show the land and buildings at cost. We are trying to be prudent. Then consistent, we are saying the same methods that are used to calculate depreciation and the rate must be constant over the lifespan of an asset. So if you are calculating depreciation on equipment at 10% on costs, we expect you to continue using the same rate, 10%, and the same method, cost price, over the lifespan of the equipment that you are using. Now, you have to read through these ones from our module 7 and other resources, but it is theory you need to read through. So you have noticed that most, if not all, the GAAP are influenced by the transactions on fixed assets. Disposal of an asset. We have some reasons why an asset can be sold. High maintenance cost. When an asset is old, or when an asset is outdated, or it is obsolete, or technological advancement. These are some of the reasons you can read through and find. Methods of disposing. To dispose means to get rid of. So an asset can be sold for cash. The contra account will be bank. It can be sold on credit. The contra account will be debtors control. Trade in. The contra account will be creditors control, and donated. The contra account will be donations. When you're talking of contra accounts, these are the names or the details that you record in the disposal account when you are preparing it in the form of a ledger account. Now, we need to understand the concept of asset disposal. What it means is, when an asset is sold, all the information in respect of that asset must be removed from the books of the business. We are referring to the cost price. It must be cancelled from the costs of all the assets that we have. The total depreciation charged up to the date of sale, it must be removed from the accumulated depreciation account. There are 5 steps that we need to take when we are doing a disposal account. First step is to remove the cost price from the asset account. We debit asset disposal. We credit the asset account. An asset disposal account, it's a nominal account that we create temporarily only to calculate if we have made a profit or a loss on sale. After that, we close it down. So an asset disposal account, it's a nominal account because we want to find out if it is income or an expense to the business. Step 2, you bring the extra depreciation into account. Normally, when they ask questions, they might give us depreciation up to the beginning of the current year. When we have used the asset for 2 months, for 5 months, or for 10 months before it is sold, that amount of depreciation, you need to calculate it. That is what we are referring to as bring the extra depreciation into account. Step 3, remove the total or accumulated depreciation. How do we do that? we debit accumulated depreciation account and we credit asset disposal. Then we record the selling price. This is what we have, the value of the asset sold. We debit either bank, debtors control, creditors control, or donations, depending on the method of disposal, and we credit asset disposal. Then the last thing to do is to calculate the profit or loss on sale. On this one, we are going to explain it further. When we are talking of loss or profit on sale, if the selling price is greater than carrying value, then we have made, or the business have made, profit on sale. If the selling price is less than carrying value, then the business has made a loss on sale. But the topic of sale of asset, it affects our financial statements in different ways. In the normal income statement and balance sheet, we need to calculate profit or loss on sale. If it is profit on sale, we record it in our income statement as other income. If it is a loss on sale, the value of the loss is recorded under operating expenses in the income statement. Then in the balance sheet, carrying value is recorded in the fixed asset note. So you need to know which question is asking for this sale of asset to know how to treat it properly. Then the same topic, it affects our cash flow statement as well. But in the cash flow statement, assets are sold at carrying value always. This amount can be given, or a question might start by giving us a fixed asset note. You fill in the figures, then it is a cash flow question. Or it is a missing amount. If the information is not clear, you can use the carrying value of assets sold. You can calculate it by using the 5-finger method. Remember, in the 5-finger method, we have carrying value at the beginning, carrying value at the end, additions, disposal, and depreciation. So if we are given 4 out of the 5 items, you can calculate the 5th item. Then this carrying value will be recorded in the cash flow on the section of investing activities as proceeds on sale of asset. It is cash inflow. The fixed asset note, this is the main objective of this one. We need to know that it has 3 sections. At the beginning, during the year, referred to as movements, and at the end of the year. There are some basic formulas that you need to know as you approach the fixed asset note. Our aim of preparing the fixed asset note, we want to calculate the carrying value of all our assets at the end of the year. But questions may vary on what they are asking. The most common one is when we are filling in the missing figures. So one important formula is how to calculate carrying value. Carrying value is equal to cost price minus accumulated depreciation. So it is an equation. Given any 2 of these amounts, either carrying value or accumulated, cost price and accumulated, you can calculate the third one. So it is a formula which you need to know. Another important formula is when you are calculating additions or the cost price. It can be cost price at the end, it can be additions, or it can be cost price at the beginning, or the cost price of the asset which was sold. So we're going to say cost price at the end is equal to cost price at the beginning plus additions at cost minus cost of assets sold. So when calculating cost price, use only cost price in the working. We have noticed some transactions from yesterday's work which increase the cost price, the ones which we call direct cost, those transactions which increases our cost price. Then how to calculate disposal at carrying value? As long as it is carrying value, the same formula will be used. Cost price of assets sold minus accumulated depreciation of assets sold. This accumulated depreciation will be until the date the asset is sold. If it is sold during the year, you need to add part of or the fraction of the year depreciation to the accumulated depreciation of that asset. Depreciation for the year. This one is an important concept under movements. We want us to use the SON method or formula. You calculate your S stand for depreciation for the asset sold. The O stands for old assets or remaining assets. This one are the assets which were in our business from the beginning till the end of the financial year. So the period is always 12 months if it is old. Then new asset bought during the year, you calculate the fraction of the year. So when you calculate, you need to change some of the figures. You also have to reason out whether some figures were already entered or were not entered. Then the last formula is accumulated depreciation at the end. We calculate by saying accumulated depreciation at the beginning plus depreciation for the year minus accumulated depreciation of assets sold. So as you approach a fixed asset note, you need to understand these formulas because some of or most of the figures are going to be calculated as missing figures, as we will see from the example we are going to do. So use formulas to calculate the missing amounts in the fixed asset note. Now we have a question here which says calculate the missing amounts. We have land and buildings at the beginning. One thing with land and buildings, you have to know land and buildings do not depreciate. That is a very important point. Land and buildings do not depreciate. So our cost at the beginning is equal to carrying value 6,800,000. Our cost at the end is equal to carrying value at the end 5,800,000. We are to calculate A. A is disposal at carrying value. Then for vehicles, at the beginning we have carrying value and we have accumulated. B is missing, which is the cost. Then on equipment we have cost and accumulated. We want to calculate C, which is carrying value. Then we also want to calculate disposal at carrying value. We want to calculate also depreciation for the year for equipment. So when you are calculating, you need to take into account the information because it must help you to figure out the missing amount. We have additional information on the right of the fixed asset note. Part of land and buildings was sold during the year. Then a new vehicle was bought on 1 November 2018. We need to understand those dates because we talk of new, we need to know how many months the asset was in our business. Our financial year ends on 28 February 2019. No vehicle was sold during the year. A printer bought 150,000 on 1 March 2016 was sold at carrying value on 31 August 2018. A new printer was bought on the same date, and the depreciation equipment is calculated at 10% on cost. Now, how do we calculate A? We calculate A by using the formula, and we also know that land and buildings do not depreciate. and we are told that part of the landed building was sold during the year. So we are saying our cost at the beginning minus our cost at the end will give us the difference, which was sold 1 million. Then B, it is cost. We are given accumulated and carrying value. So 960,000 plus 840,000 will give us 1.8 million. So the formula that you must use is carrying value is equal to cost price minus accumulated depreciation. C, we are calculating carrying value, which means cost 850 minus 108,000, our accumulated depreciation will give us 670,000 as our carrying value. D, we are calculating disposal at carrying value. Now, a printer was sold, but we know disposal at carrying value. Our formula says cost price of the asset sold minus accumulated depreciation of the asset sold. Here you are going to notice that this asset which was sold, we are not told or we are not given the depreciation until the date it was sold. You have to calculate all the way back from the day it was purchased to the day it was sold. So it was bought 1st of March 2016. 1st of March 2016 until 28 February 2017. That is one financial year. Depreciation is 15,000. Then 1st of March 2017 to 28 February 2018. Full year, another depreciation of 15,000, 10% of 150,000. Then from 1st of March 2018 to 31 August 2018, it is 6 months. So we calculate depreciation for 6 months to give us 7,500. So our depreciation for accumulated depreciation will be 150 cost minus 37,500, the accumulated until the date was sold, to give us 112,500. Then E, the depreciation for the year. That's where now we use the SUN method. You need depreciation for the asset sold, you need the remaining or the old, you need the new. Let's start with the sold. Already we calculated, when we were calculating D, it is 7,500. The old, if you go back to the equipment, our cost price was 850 minus the cost of the asset sold, because we are calculating depreciation for the old separately, to give us 700,000 times 10% times 12 over 12 to give us 70,000. Then new, it is 400,000 multiplied by 10% for 6 months, 20,000. You need to see that one. I have made a mistake. It should be 70,000 instead of 700,000. So our depreciation for the year is 7.5 plus 70,000 plus 20,000. That is our E. You are going to practice preparing the fixed asset note. This fixed asset note you are going to do not have one rand rule. Our next topic will be on one rand rule. So you are going to receive a worksheet with questions that you are going to practice, but feel free to do the fixed asset note.